Hello and welcome to this budget update. There has been loads and loads of speculation in the last few months. The Treasury, Rachel Reeves, Rachel from Accounts, have been flying a kite. They have been issuing lots and lots of leaks to the public and to the newspapers around what tax rises are coming. They've been testing their proposed tax increases to see what the response is likely to be from the general public and probably from Labour voters. It has caused inaction. Lots of people have put off making investment decisions. They haven't bought businesses. They haven't invested in properties. Lots and lots of people who were buying homes, especially over 500,000, have put that off because they don't like the uncertainty. They're not sure what the tax rates are going to be. Is there going to be an increased council tax surcharge on bigger properties? All of this stuff has created inaction. I think part of this strategy is also to flood the zone so that when the budget comes, potentially, they introduce less of these taxes and everyone sort of thinks, oh God, that wasn't quite as bad as we thought. A bad strategy. I think it has put a real cap on economic activity. I think it has cost the country and the government lots of money, but it doesn't look like Labour care about that. So let's get stuck into this. Let's find out what's happened and let's see how it impacts you. Now, before we get started, remember to like, subscribe, and hit that bell button. So what is it that they have changed? Well, the first biggest change that I can see that will impact landlords, impact people who've got shares, impact people who've got investments, who take dividends, and impact savers is that they are adding 2% onto the basic rate of tax for income from those sources. So it's almost like an unearned income surcharge, which we've not had for a long time. It's typically Labour. I think they had something similar in the 70s, and it's going to increase the tax that you take on any properties that you hold, any income that you take, and it's going to increase the tax on any income from, say, businesses that you own. You maybe even work. You're a working person, but you're going to be paying 2% more if you're a basic rate taxpayer or a higher rate taxpayer or an additional rate taxpayer. So, I would say that's probably the biggest wide-ranging increase in tax for most of the population. In addition to that, the Chancellor has frozen tax thresholds. So the amount of money at which you start paying higher rate or additional rate tax has been frozen again, which is called fiscal drag. It's a bit of a stealth tax. Lots of people look at it and the Chancellor can say, oh, I haven't increased your rate of tax. But of course, if you have to start paying higher rate tax, 40% tax or more at the same amount that you did last year, but there's been inflation and therefore you're getting less for your money, that means actually they have increased taxes. They've done this for a number of years and they have now frozen this for several more years. So I would say that is a huge part of the tax increase that we're all going to bear. It's on working people, it's on everybody. The next big tax increase for property owners, those who've got HMOs, commercial buildings, is an increase in capital taxes. Some of us claim capital allowances. The writing down allowance is now going to be reduced from 18% to 14% from 2026. And there's only going to be 40% of capital allowances available in the first year. So this is definitely something to talk to your capital allowance accountant or your general tax accountant about, because these are quite significant changes. So the next big change is the new high value council tax that is going to apply to properties over £2 million. So this is primarily if you live in a property of £2 million or more, because as a landlord, your tenant is likely to be paying that tax. They're going to increase the amount of council tax by £2,500 to £7,500 a year, depending on how much over £2 million it is. I think there's another £5 million threshold. Clearly, that will largely affect properties within London and central London. I think that will be a further drag on the prices of those properties. They've been falling for a number of years. This is clearly going to exacerbate that. Below 2 million, they say they're going to reevaluate the council tax bands of F, G and H. So I think that's another bit of a stealth move there. They're going to look at F, G and H and revalue those properties. So I suspect some of those properties will go up in terms of the band, and therefore they will get more tax, more council tax through that route. Another big change to pensions, salary sacrifice schemes. There's going to be anything over £2,000. You're not going to get your national insurance. They say they're not going to reduce the allowance on pension contributions in terms of taxation. And they're also not going to remove the allowance whereby you can take 25% out of your pension once you're 55, probably soon to be 57 or 58, without paying tax on it. Will they do that in the future? I think it's back on the list, probably at the next budget. Do we believe that this is the last time she's coming for money? Absolutely not. Employee ownership trust, this is quite a big change. Businesses, or the owners of businesses, have been able to sell their businesses to a trust which is controlled by the employees and put that capital gain effectively on the director's loan account and then draw against that over a number of years. Those transactions now, instead of them being free of tax, the relief is going to be limited to 50%. So that is a huge amount of capital gain that potentially they're going to get from those businesses. It is going to be a big disincentive to sell your business to an employee ownership trust to benefit the employees. It was something that I was considering, and clearly that door has been closed. So I suspect there are going to be a lot less employees benefiting from that, even though she was talking about making it more attractive for employees to own shares through EMI schemes and the like. In reality, I think they've closed the door on a lot of that. There's going to be a new electric vehicle excise charge, primarily for electric cars. It's going to be 3p per mile, and on hybrid cars, they're going to increase that by 1.5p per mile. Clearly, on a hybrid car that does 12,000 miles a year, that's an extra £180. Not a huge amount, but it's chipping away. You know, they've sort of got everybody to have an electric car. They've got lots of people to take a hybrid, and now they want to tax it. So clearly not something that's positive. Maybe you're better just sticking with your petrol or diesel. Like Gordon Brown and Tony Blair told us to do back in the 90s, before the government then said that particulates were too high out of the diesels and they didn't like them anymore. Cash ISA allowance is now reduced to £12,000 a year. You can top that up with investments in stocks and shares, a further 8,000 to have still the overall allowance is 20,000. Notice they haven't increased the allowance with inflation again, so it's still 20 grand. And effectively, they've reduced the amount that you can put into a cash ISA by £8,000. So that's definitely a negative thing from April 2027. And business property relief and agricultural property relief is now transferable between spouses for inheritance tax purposes. So those reliefs, if you haven't used them, or if one parent's died and that hasn't been utilised, then they are transferable. So that's a small tax giveaway. I suspect that's aimed at the farmers and a few business owners, but above £1 million, clearly there's not much left to claim on that. The big news is there is no exit tax, it looks like, which was effectively a settling up charge that business owners were going to be liable for if they sold a business and immediately then became non-resident. You were going to be held in that trap. It doesn't look like they're doing that, and it doesn't look like they're introducing a wealth tax. So I suppose that is a little bit of a silver lining with these sort of dark clouds. However, I suspect they'll be back on the agenda in future budgets. Labour have got several more budgets within this parliament, and I suspect there'll be further speculation on those two taxes. Clearly, the biggest change to all of us is going to be the Renters Reform Act. That's not part of the budget. That's starting next year. I will go through that, what the implications are likely to be, in a subsequent video, but those are the main tax changes to impact investors, property owners, business owners in the budget of November 2025. Clearly, Labour have it in for wealth creators, for entrepreneurs, for anybody generating tax in this country, the people and the businesses that employ people and generate all of the tax, the 1.2 trillion that the government spends every year. They want to hit them over the head. Lots of people have left. Initially, Labour was saying, oh, this is just wealth management firms releasing statements on this and anecdotal studies. But the reality is that government ministers are now accepting that lots of wealth creators are leaving. Loads of people are going to Dubai. And I'm not sure how this budget helps stem the flow of entrepreneurs, of non-doms, of people with cash and the ability to employ people and generate future taxes for the country. This budget marks a new high. We're not at a post-war high now. We are now at the highest tax level ever. So it is a new tax high. That there hasn't been a greater overall tax take by the UK government. We are beyond the point on the Laffer curve where they are able to increase the tax take from increasing tax rates and the things that they tax further. So I don't really understand why they keep putting tax up, because all it is meaning is their tax base, the number of people paying it, is reducing. And we can see the effect of this doom loop that has been going on, especially since the last budget. So what's the strategy? What do we do now? Well, it's made lots of properties cheaper. It's made lots of investments cheaper. I think it's a good time to buy. I think it's a good time to go out into the marketplace to generate income potentially from commercial conversions, from renting residential property out, taking commercial tenants on. We've just completed on 2 deals. All this uncertainty has made the market very soft. So I would use it to your advantage, bid hard to get more deals, because I think there's more and more available. Why are we in this position? Government debt is now over 2.7 trillion. We're spending over 110 billion a year just on debt interest. Clearly, the interest rate that the government is having to pay on their gilts has gone up hugely since interest rates went up, since they printed too much money and closed the supply chains in COVID. But they are hammering people and the businesses that generate the income and taxes which the government use to run the economy. I hope that budget update has been useful for you. We're going to go into it in a lot more detail at our multiple streams of property income event. We go into a lot of depth in how to implement all of these strategies, all the way from tax to building new opportunities which create cash flow for you. So click the link in the description to secure your place now. That has been Mark Homer, over and out.